President Trump is crashing the stock market. And what about AI stocks? The stock market is going down fast, having lost more than 10% of its value in just a few days. Tech and AI stocks are down even faster. What is happening? Is this all due to President Trump policies? Trump-era tariffs. The return of Trump-era tariffs, or the threat of a new one, is shaking up markets. Investors are worried because tariffs make imported goods more expensive. Companies that rely on these goods face tough questions. They can eat the high costs, which hurt profits, or pass them to customers, which might slow down sales. Either way, earnings could take a hit. This uncertainty makes investors nervous, leading to stock sell-offs. Markets also fear inflation. If tariffs push prices higher, the Federal Reserve might keep interest rates elevated, risking a recession. These factors combine to create a volatile environment where stocks swing wildly on trade-related headlines. What is a tariff war? A tariff war happens when countries slap taxes on each other's imports to gain leverage. For example, the US might tax Chinese goods, and China responds by taxing American products. This tit for tat hurts both sides. In 2018, the US targeted Chinese electronics and machinery. China then retaliated by taxing American soybeans and cars. Other countries like the EU and Canada also fought back with tariffs on US steel and whiskey. Trade partners aren't sitting idle. Some are forming new alliances to reduce reliance on the US. The Asia-Pacific region, for instance, deepened trade ties through agreements like RCEP. Companies are also shifting supply chains out of China to countries like Vietnam or Mexico to dodge tariffs. These moves fragment global trade, raising costs and slowing growth worldwide. Impacts on the US economy. The US economy isn't immune to that fallout. Tariffs raise prices for everyday items, acting like a hidden tax on households. Studies show past tariffs cost the American families over $1,000 a year. Farmers took a direct hit when China stopped buying US soybeans. The government then spent billions on bailouts to keep farmers afloat. Factories didn't see the boom Trump promised. While some steel jobs returned, higher metal prices made US-made cars and machinery more expensive, offsetting gains. Long-term damage includes strained relationships with allies. Europe and Canada now question US reliability, weakening America's influence in global trade talks. Economists estimate tariffs could shave 0.5% off US GDP if they escalate again. Effects on US stocks. Certain stocks rise or fall depending on tariff exposure. Companies making steel or aluminum in the US, like Nucor, benefit from less foreign competition. Manufacturers using American-made parts such as Caterpillar might also gain. Defense contractors like Lockheed Martin could see demand rise if tariffs push the government to buy local. On the flip side, automakers like Ford and GM face higher costs for imported materials and lost sales in countries that retaliate. Tech giants like Apple, which make products in China, could see profits squeezed. Agricultural firms like Tyson Foods suffer from export drop. Investors should watch these factors and see opportunities or risks. Effects on AI stocks. AI stocks faced a mixed outlook. Companies that design AI software like Palantir are safer because their products aren't taxed at borders. But firms relying on imported hardware, such as Nvidia, which needs chips from Asia, could face higher costs if tariffs hit electronics. There is also a potential upside. Tariffs might push companies to automate more to cut labor costs, boosting demand for AI-driven robots or software. However, broader market chaos could drag down tech stocks temporarily. Investors with a long-term view might see dips as a chance to buy into AI's growth story. Quick market drops can be scary, but they also create opportunities. One strategy is short selling, betting that a stock will fall. For example, shorting automakers hurt by tariffs could pay off if shares drop. Another tactic is buying put options, which let you sell stocks at a set price, locking in profits if prices fall. Inverse ETFs, which rise when markets fall, offer a simpler way to bet against the market. Safe haven assets like gold or utility stocks often hold steady during a turmoil. But these moves are risky. Timing the market is hard, and losses can pile up fast if the rebound catches you off guard. Some sectors tend to thrive in a tariff-heavy world. Energy companies like Exxon could gain if the US taxes foreign oil, boosting domestic demand. Defense stocks often rise when governments prioritize local production. Utilities and healthcare stocks, which sell essentials, are less affected by economic swings. Companies shifting factories to the US, like Tesla with its gigafactories, might dodge tariffs and win favor. Investors should focus on industries with strong domestic demand or those seen as safe during uncertainty. Buying or selling AI stocks. Deciding whether to buy or sell AI stocks depends on your strategy. If you own AI hardware firms exposed to tariffs, consider trimming your position until trade tensions ease. But if you're focused on software companies or believe in AI's long-term potential, market dips could be a buying opportunity. The key is to separate short-term noise from lasting trends. AI is reshaping industries from healthcare to logistics, and that growth likely isn't derailed by tariffs alone. Diversifying your portfolio leads to balancing risks. Keep an eye on trading negotiations and companies' earnings for clues of where to pivot. If you enjoy this kind of market analysis, I'm creating a newsletter that delivers professional stock research for people who want to stay ahead of market trends. For a small introductory price, you receive weekly analysis, stocks that are at a good buying points and at profit-taking points. Check the link below and start receiving real trading education. Summary. Tariffs create winners and losers. Companies tied to local manufacturing or essential services tend to weather the storm. Tech and global exporters face more risk. AI's future remains bright, but stock prices might wobble as traders react to headlines. For investors, staying calm and focused on long-term goals is crucial. Use volatility to your advantage, buying strong companies at lower prices, and protect your portfolio with safer assets. Trade wars rarely last forever, but their side effects can linger. By understanding the risks and opportunities, you can navigate this turbulent phase with confidence. That's all for today. Thank you for your attention. If you like this content, please subscribe. And I see you next. Bye-bye.